We're committed to making the best decisions we can based on facts and objective analysis. Today, we decided to lower the interest rates for the third time this year. We took this step to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risks. As I will explain shortly, the policy adjustments we've made since last year are providing, and will continue to provide, meaningful support to the economy. We believe that monetary policy is in a good place. The U.S. economy is in its 11th year of expansion, and the baseline outlook remains favorable. The overall economy is growing at a moderate rate. Household spending continues to be strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on those sectors. Looking ahead, we continue to expect the economy to expand at a moderate rate, reflecting solid household spending and supportive financial conditions. The job market remains strong. The unemployment rate has been near half-century lows for a year and a half. The pace of job gains has eased this year, but has remained solid. We had expected some slowing after last year's strong pace. Participation in the labor force by people in their prime working years has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. You have the interest rates move down as well because there's an inflation component. Looking ahead, we'll be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the Fed funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. So that's what I would say. But corporate debt is. We're also, as part of our review, looking at potential innovations, changes to the way we think about things, changes to the framework that would lead us, that would be more supportive of achieving inflation on a symmetric 2% basis over time. That's at the very heart of what we're doing in the review. It's too early to be announcing decisions. We haven't made them yet, but we're in the middle of thinking about ways that we can make that symmetric 2% inflation objective more credible by achieving symmetric 2% inflation. And it comes down to using your policy tools to achieve 2% inflation. So we're going to be adding reserves to get back to that place. That's one thing. There are also, we think that inflation expectations are very important in driving actual inflation, and we're strongly committed to achieving our 2% inflation objective on a symmetric basis. We think it's essential that we do that. So we're not thinking about raising rates right now. There obviously will be times in the future where that will be appropriate. What we're really thinking now is that our current stance of policy is appropriate and will remain so as long as the outlook is broadly in keeping with our expectations. It may be one thing that was surprising about the episode was